So let me ask you something. What if I told you that you might be missing out on over half of the world's investment opportunities? It sounds crazy, right? Well, today we're going to talk about exactly that, how to take your portfolio global, and why it might just be the most important strategic shift you can make.
But first, I want you to take a second and really think about your own portfolio. Are you pretty much all in on companies from just one country? Probably your own. Hey, if you are, you're not alone. It's super common, but you might be leaving a whole world of opportunity on the table.
And this chart, wow, it really paints a picture, doesn't it? If you're only investing at home, you're basically playing in that smaller slice of the pie. The vast majority of economic growth and new ideas, that's happening everywhere else. And by staying local, you just can't tap into it.
You know, this tendency is so common, it actually has a name. It's called home country bias. It's totally natural. We invest in what we know and what feels familiar. But here's the thing, what's familiar isn't always what's most profitable. Just understanding that this bias exists is the first huge step to building a smarter, more global portfolio.
Okay, so why should we even bother fighting this bias? Well, let's dive into the really powerful reasons for going global. It really boils down to two huge, game-changing benefits. First, you get access to economies that might be growing way faster than your own. Think about all the fintech innovation happening in Southeast Asia or the boom in renewable energy up in Northern Europe. And second, you get powerful diversification. When one market is having a bad year, another might be soaring, which really helps to smooth out your returns over time. I love this quote because it gets right to the heart of it. Staying only in your home market might feel safer, but you're actually concentrating all your risk in one single place. True risk management isn't about hiding from the unknown. It's about strategically spreading your investments out to build a stronger, more resilient portfolio. And to put a number on it, get this. Over 60% of the world's investment opportunities are outside of the US market alone. Just let that sink in for a second. By staying local, you could be ignoring the majority of the world's publicly traded companies. That's huge. So you're probably thinking, okay, I'm convinced, but how do I actually do it? Well, the great news is you don't need to be some Wall Street genius. It's more accessible today than it has ever been. Let's explore the main ways you can start investing globally, right from your own computer. We're going to break down three really popular methods: international ETFs, mutual funds, and something called ADRs. Each one is a little different depending on your goals and, how hands-on you really want to be. All right, first up, let's talk about the two heavyweights, ETFs and mutual funds. The easiest way to think about it is that ETFs are kind of like the do-it-yourself option. You can buy and sell them just like a stock. They usually just track an index, and their fees are generally pretty low. Mutual funds, on the other hand, are the managed-for-you option. You've got a professional manager actively picking the investments, which is great, but that's also why they often come with higher fees. Now for our third pathway. What if you're not looking for a whole basket of stocks? What if you want to invest in one specific foreign company, say a German automaker or a Japanese tech giant? That's where ADRs come in. They're basically certificates that stand in for foreign shares, but they trade right on US exchanges, which makes it super easy to buy individual international stocks. So let's put it all side by side here. As you can see, both ETFs and mutual funds are fantastic for getting high diversification right out of the gate. The big difference really comes down to cost and management. ETFs are your low-cost, passive option, while mutual funds are actively managed and tend to cost a bit more. ADRs are perfect for targeting a single company at a low cost, but remember, you're not getting that built-in diversification. Okay, let's tap the brakes for just a second. Like any investment, going global isn't a magic bullet. It has its own unique set of challenges, and it's really, really important to go in with your eyes wide open. So yeah, while we're out there chasing all this incredible opportunity, we have to be smart about the unique risks that show up when you start investing across borders. Let's look at the two biggest ones you need to know about. First up is currency risk. This one sounds complicated, but it's pretty simple. Let's say you invest in a cool European company. If the euro gets weaker against your home currency, say the dollar, then your investment, when you convert it back, is going to be worth less. And that can happen even if the company's stock price didn't move an inch. Of course, it can also work in your favor, but it's another moving part you have to keep in mind. And then there's political risk, a surprise election result, a sudden change in trade rules, or any kind of instability in another country can have a direct and sometimes immediate effect on its stock market.
It's just another layer of uncertainty that's a lot more pronounced when you're investing outside your home country's system. So, we've covered a ton of ground: the why, the how, and what to watch out for. Let's tie this all together now and recap the most important stuff for starting your global investing journey.
All right, so if you remember anything from this, remember these 4 things. First, recognize and get over your own home country bias. It's key. Second, never forget the twin benefits. You get access to global growth and powerful diversification. Third, ETFs and mutual funds are your simplest and most effective on-ramps to get started. And finally, always be aware of currency and political risks.
You know, this quote from Ben Franklin is just perfect here. The time you just spent with me learning about all this, that's a direct investment in your own financial future. Knowledge really is the foundation for making smarter, more confident decisions with your money. And that really brings us to the end. We've shown you the map, we've talked about the different ways to travel, and we've pointed out some of the road signs to watch for. The only question left is, with a whole world of opportunity waiting out there, where will you explore next?